What do you make of the hurly-burly? Powell has just reinvigorated markets again. What do you make of his delivery to the markets last night?
Well, listening to him, it just seemed as a pragmatic approach on his part. Actually, not surprising, knowing Jay Powell. I think he's signaling really a pragmatic response to whatever the global situation may be, whether it's trade tensions or anything else, which is not too dissimilar to the way we do our role as market overseers to respond to global conditions, whatever they may be, to make sure that our markets continue to function in a straightforward and an orderly manner.
Chris, why are the bond markets so aggressively pricing rate cuts from the Fed?
You know, that's the thing about markets. They are taking in all the factors, as they should, and coming up with a market-based approach. As someone who believes very much in markets, I think this is a normal approach.
The one thing that we try to get a handle on is liquidity. And this has been the great debate about the changing regulation of banks and markets in the past 10 years and the consequence on liquidity. We had the head of Deutsche Bank with us yesterday. He's worried about liquidity. From the conversations that you have on market structure, specifically, are you hearing any concerns about liquidity?
Oh, absolutely. When we talk about, to me, as a market regulator, liquidity means trading liquidity in our markets. What we had over the last several decades in our global derivative markets, largely centered here in London in this global swaps market, was a global pool of trading liquidity. One of the concerns is that as a result of the reforms, whether it be through staggered implementation or different implementation by regulators and regulatory jurisdictions around the world, that we're taking this once global pool of trading liquidity and breaking it up to ever smaller pools of regional or in some cases national liquidity that themselves become a potential source of systemic risk, because in a crisis, those individual pools of liquidity are shallower and more susceptible to inordinate reactions to market dynamics. The analogy I use is if you throw a pebble against a very shallow pond, the ripples are even bigger than they would if you throw a pebble into the ocean. We had an ocean of trading liquidity in global markets, and the concern is that we now have a series of ever smaller puddles of liquidity, which could be a problem.
Yeah, so with this swaps framework 2.0 that you introduced in October 2018, of course, you're coming towards the end of your tenure. So what do you hope to see after you depart the CFTC to avoid these dislocations that you're referring to?
Well, thank you for that. So what we did was last October, I released an extensive white paper pledging the CFTC, my agency, to return to an approach of deference to competent local regulators in their implementation of the swaps reform. Previously, we had taken an American approach that was very extraterritorial. Now, what we're looking to do is have much more of a deferential approach to competent authorities around the world, and we're following through with that. And before I leave the Commission, we will put forward a series of actual rule texts that will embody this deference approach in our rule sets.
Can I ask you, Christopher, just to circle back to your point? You talk about pools of liquidity and the risks therein. For me, this business has always been about liquidity and costs. So if I'm going to get a dissipation in liquidity or we're in the foothills of that, where am I in terms of the ensuing costs associated with clearing? Because that's perhaps what comes out the other end of the tube, isn't it?
Yeah, well, so it's actually such an interesting question, because one of the impacts of the global reforms has to overlay our financial markets with an increasing level of capital complexity and operational complexity. And the marketplace is struggling with this additional expensive and complicated overlay on how they deploy capital and how capital can be used for trading liquidity. I think that's one of the reasons why you're seeing such emphasis right now on financial technology, fintech, regtech. It holds the promise of being able to cut through this added capital and regulatory complexity that's been overlaid on the financial markets.
And I'm so glad you brought up fintech, because one thing you've talked about in some of your presentations before is that you want to make the CFTC a regulator for digital markets,
Yes.
which moves us neatly on to cryptocurrency, something you've talked about before. I think on Twitter you
Yes,
were
indeed.
#CryptoDad. I absolutely love it, Chris. What do you think then of Facebook's plans for a virtual currency? Are you in conversation with them?
What's been fascinating is that Bitcoin, which has been around since the last of the financial crisis, really it became a much more mature product when the Bitcoin future was launched. That allowed institutional money to come into the marketplace. And I think that as we see additional asset classes come on the scene, they're approaching the markets for both their development of a spot market, but also for the development of a derivative market as well. And so as a derivative market regulators, I would say we're in conversations with all the major digital asset classes that are on the horizon right now.
And that, I suppose, co-joins with blockchain. You're about to leave, but those conversations have already started. What prism do you look at blockchain at within the CFTC? What role is blockchain going to play?
Yeah, so I'm one of those who really believes that blockchain has tremendous potential in the market. And it has tremendous potential for market regulators. And the reason I say that is because I was there in 2008 when financial market regulators had no better way of assessing the counterparty credit exposure of one large financial institution to another than by actually calling brokers that were broking credit default swaps to understand where the risk premium was. And they were, in a sense, guessing at what the global notional amount of exposure. So at the time of the crisis, it was believed that there was $400 billion in credit default swaps protection written against Lehman Brothers. Well, we now know that the total exposure was less than $8 billion. If we knew in 2008, and we would have known in 2008 if all those swaps had been on a blockchain, that the exposure of Lehman Brothers was $8 billion, then the response of global regulators and market overseers could have been a very different response than the response that came. Blockchain gives us the prospect that someday we may actually know with precision the exposure of one financial institution to another. We may be able to map the entire financial regulatory system. They call it financial cartography, and that's what blockchain gives us. So as from a regulator's point of view, this is a tool that has enormous potential and one that we want to be very much in the forefront of exploring and understanding.
That is so interesting. And as you mentioned credit default swaps, are you satisfied with the way the CDS market has evolved since the CFTC criticized manufactured credit events back in April 2018?
So we're following this very carefully. And what I can tell you is I think that the leaders of the industry are taking a very responsible approach to this. ISDA, the International Swaps and Derivatives Association, has been working with major participants in the market to develop some new language in their standard protocols to govern this area. They've been in dialogue with our agency, the CFTC, and will remain in dialogue with them as we go forward. So I think the initial steps on this are the right ones, but we stay very much engaged.
Christopher, can I pick up on that discourse about counterparty risk if we take our minds back to 2008, we simply didn't know nor understand the size, the magnitude of anybody's balance sheet, and hence the reason why we ended up with Lehman's. We've traveled over the past 10 years. We've gone from OTC to on exchange. Where has performed the best? Where has been the most successful transition in terms of data, information to on-exchange information? And where's the biggest opportunity to come? Brian Moynihan warns about leveraged loans in the past 24 hours. I mean, therein lies the rub of the issue. Do you know the counterparty risk of who's got leveraged loans out there that's sour?
Well, so you're absolutely right. Where's been the biggest gain? The biggest gain has been moving not onto exchange, but moving into central counterparty clearing, moving derivatives. So at the time of the crisis, I think somewhere in the neighborhood of 25–30% of interest rate swaps were cleared. Now it's over 85% for U.S. institutions, and I think globally it's over 70%. In the area of credit default swaps, it was a handful of that market that was centrally cleared at the time of the crisis. Now we're over at 85%, certainly from the U.S. Side of the coin, and I think similar levels around the world. So we've successfully moved which is one of the key G20 initiatives, that marketplace intercentral clearing. Yet these are instruments, you say on exchange. By on exchange, I mean electronic trading. These are instruments that have different liquidity curves. So the more liquid elements of them do trade electronically, just like in the bond market, the less liquid elements of a trade through a mixture of hybrid means of voice and electronic execution. In terms of leverage loans, it's an area we're following very closely. As you know, at a recent meeting of the United States' Financial Stability Oversight Council, the FSOC, there's been a review of leverage loans. The total size of the market, though, is still relatively modest by global standards. So we don't view it as systemically risky, of a systemic risk, but it's something we follow very carefully, very diligently, as you'd expect us to do.
Chris, I need a brief answer from you. We want to save time to discuss why you're in London. You said in a speech earlier this year that you intend to propose a new workable position limits rule that would, among other things, clarify anticipatory hedging. This is important for the US market. Is that still the case, that a rule is coming out?
Yes, it is. So we have had in the United States for decades position limits on a range of products, mostly in the agriculture area. And those position limits have worked well. The proposal that was put before our commission several years ago was one that was much too expensive and actually had banned hedging practices that have been used in American agriculture and other American commodities production for decades, especially on American family farms. We'll put forward a rule proposal that will be much more intuitive, much more useful to persons participating in these markets.